So, the market just smashed through to all-time highs. But wait, wasn't it in a complete freefall just a few days ago? What on earth is going on? In this explainer, we are going to cut right through all that chaos and figure out how to navigate this wild ride.
Welcome to our latest market update. We're going to be looking at everything from US stocks to precious metals and, of course, crypto, to build a really clear, actionable strategy for you. So here's the big mystery we need to solve. The Fed basically gave the market exactly the news it wanted to hear, but the first reaction? A massive panicked sell-off. Then, less than 24 hours later, we're rocketing to new records. It makes no sense, right? Well, that's exactly what we're going to unpack. Okay, so to really get what happened, you have to understand that Fed announcement days are, well, they're famously volatile. It's often when the big institutional players use all that chaos to shake out the smaller investors. Reacting in the heat of the moment, that is a classic recipe for losing money, and here's exactly why.
Just look at this timeline. It shows the classic fake out perfectly. You see the market rallying into the announcement, looking super strong. Then, bam, 230 hits and it's pure chaos. A huge spike up, followed by a brutal 3% drop right into the close. Now, anyone who panicked and sold there got completely crushed. Why? Because the very next day, a complete 180 and a blast off to new highs. This is exactly why you can't trust that initial reaction. All right, so if that knee-jerk reaction was just a smokescreen, what's the real story? The truth is, the market's long-term direction isn't about the day-to-day drama over interest rates. Nope, it's driven by something much, much more fundamental.
And here it is. This is the key insight, and it's drawn from the deep analysis of economists like Professor Steve Hanke. He basically argues that almost everyone, and that includes the Fed itself, is watching the wrong thing. They're obsessed with interest rates, when the real story, the real driver, is the total supply of money in the economy. So what exactly is the money supply? We're talking about something called M2. The easiest way to think about it is just the total pool of money sloshing around in the economy, everything from physical cash to your checking account. And believe me, how fast that pool of money is growing or shrinking is a super powerful predictor of what's coming next for the economy and for inflation. Now check this out, because this is where the story gets really interesting. For the first time in modern history, the US money supply actually shrank. It contracted. You can see it right there on the chart. That almost never happens. And now, even though it's started to grow again, the pace is just incredibly slow. Right now, that growth rate is sitting at just 4.8% a year. And according to the monetary experts, that is simply not enough fuel to create sustained high inflation. It suggests all these inflation scares we've been seeing are really just temporary blips, not some big new trend. The market is finally figuring this out, and that's the real reason it's pushing to new highs. Okay, so we've got the big picture driver. Now let's connect this directly to a strategy for the US stock market. What does this slow money supply growth actually mean for your portfolio? Well, it means the market's foundation is looking really solid, and you can see the proof everywhere you look. It's not just one sector leading the charge. You've got the broad S&P 500, the tech-heavy Nasdaq, and the industrial Dow Jones all breaking out together. That's a huge sign of broad-based strength. So here's the absolute key takeaway for stocks. With these underlying monetary conditions looking so favorable, the path of least resistance is up. And what that means for you is that any major pullback from here shouldn't be seen as a threat, but as a clear-cut buying opportunity. All right, let's switch gears and apply this same thinking to precious metals. The outlook here is also pretty positive, but it requires a little more nuance than our simple buy-the-dip strategy for stocks. We really need to look at gold and silver differently. So, let's start with gold. It's already had a monster rally, basically pricing in a lot of the good news about lower rates. So the smart move here is probably to just pause any new buying and let the price settle down a bit. Silver, on the other hand, well, it hasn't run nearly as hard. That makes it, in my view, the more attractive buy right now. The strategy for silver is to accumulate, to buy on any significant price dips. And finally, let's dive into the crypto market. Now, this is where things get very technical, and our strategy really relies on watching specific price levels that act as triggers for buy or sell signals. Looking at the big guys, the technical models we follow are pretty much bullish across the board. For instance, one model triggered a key buy signal for Bitcoin once it got above that $11,600 level. We saw a similar thing for Ethereum above $4,554. Even Ripple has flipped back to a buy, which keeps its bullish targets in play. The technicals are definitely signaling strength here. Of course, I know what a lot of you are probably thinking.
What about all the other smaller coins? We've seen some absolutely explosive moves there, but has that run finally come to an end? To answer that, we need to look at one very specific chart.
The indicator we use is called Others Dominance. It's actually pretty simple. It just measures the market share of all cryptocurrencies outside of the top 10. So when this chart is going up, it means money is flowing into smaller altcoins faster than it's flowing into big names like Bitcoin.
And the verdict from that chart? It's crystal clear. On the weekly time frame, Others dominance is still in a firm uptrend. This tells us the altcoin rally is very much alive and kicking. Money is still rotating into those smaller, more speculative projects, so that party is definitely not over yet.
Whew! Okay, that was a whirlwind tour through stocks, metals, and crypto. Let's take a breath and boil it all down into a few simple, actionable takeaways you can actually use.
So here is your 4-step game plan. Number 1, ignore the emotional noise on Fed day. It's just a distraction. 2, watch the real driver. That's the M2 money supply. 3, for U.S. stocks, the strategy is simple. Treat any significant dip as a buying opportunity. And 4, for metals and crypto, you gotta be tactical. Accumulate silver on dips, and for crypto, follow those key technical signals we talked about.
And I'll leave you with one final thought to chew on. Right now, the market is celebrating what it sees as a perfect soft landing. But, history shows that a major contraction in the money supply, like the one we just went through, is very often followed by a recession. So the biggest risk looking forward is what happens if, and when, that recession finally shows up.
Thanks so much for joining us. We really appreciate it. And hey, if you got some value out of this, a subscription or a like would be fantastic. We'll see you next time.